So in this class we will discuss what are all the different types of mutual fund schemes are there that has been classified in a different way. That we will see, mutual fund schemes may be classified on the basis of its structure and investment objectives. So according to the structure of a mutual fund scheme, the size, the scope of a mutual fund scheme, as well as the investment objectives, the different mutual funds has been categorized. So that we will see in this flow chart, we can able to understand how the mutual fund is structured, how the mutual fund is uh, classified. Mutual funds are classified. So by the structure, mutual fund is classified by structure, by investment objectives, right? And others mutual funds are there. In by structure, what we can say that mutual fund, we can say that open ended, close ended, and interval scheme. And by the investment category, we have a four kind of different schemes, like growth scheme, income scheme, balanced scheme, and money market scheme, as well as other schemes also there, tax saving schemes, and specific industry specific scheme, index funds, right, sectoral funds, lastly exchange traded fund, shortly known as ETF. So that we will see, based on the structure, how the mutual fund are structured. According to that, they have classified into three categories, that is open ended, close ended, interval funds. So open ended funds, you know that the funds are a one that is available for subscription all through the year, in the sense that there is a free entry and free exit for this funds is there, right? It will be available for subscription. There is no restriction throughout the year, right? Anyone can able to subscribe these shares or own these shares. They can do transactions. Those do not have a fixed maturity. So as I said, there is no free, there is no uh, entry and exit, free entry and free exit, what we can call it. Doesn't have any fixed maturity, fixed time, specified time period, that is not there in these kind of funds. And investors can conveniently buy and sell at a net asset value related prices. The key feature of open end fund open end schemes is liquidity. So why? Because liquidity is a special feature in the sense that they can able to sell it at any time. There is no time period, there is no time horizon for this particular funds. They do not have a fixed maturity. That means they can convert it into they can shift it into different one, or they can redeem it their mutual funds returns, right? So that the liquidity is possible to reach out the short-term obligations of that individual or investors or unit holder. They can able to invest it in open-ended mutual fund. So certain example for a open-ended funds, we can say that SBI small cap funds are there, or we can say that Aditya Birla Sun Life banking and financial service fund are there. So in that, there is no the fixed maturity is there. Fixed maturity will not be there for this kind of open-ended funds. And and the investor can conveniently buy and sell their units according to the NAV prices. So this is what exactly you can say that open-ended fund. And next one, close-ended funds. So just contrary to the open-ended funds, it is a stipulated maturity period, which generally ranges from 3 to 15 years. Say, in open-ended funds, what happened? There is no time horizon, there is no specified time period, there is no the fixed maturity period is there in open-ended funds. But in closed-ended fund, what will happen? There is a stipulated maturity period. Generally, we can say that 3 to 15 years. So the fund is often subscription only during the specified period. So this time period, what will happen? This is often for only for a subscription, Investor can invest in the scheme at the time initial public issue. Thereafter, they can buy and sell units. Buy and sell the units, the scheme on the stock exchange where they are listed. In order to provide an exit route to the investors, some closed funds given an option to selling back to the units to the mutual fund through periodic repurchase and NAV related prices. See, there is no there is a stipulated time period, right? There is no pre-exit here. Why? Because there are closely ended fund or close-ended funds. Even though in order to provide a exit route for the investors, right? Even they can exit from this particular funds. Sometimes the business, the mutual fund will provide an option to the investors for selling back the units to the mutual fund through a periodic. It means a certain period. After a certain period, they will they will get arranged to the repurchase of that particular units at the NAV related prices. We can say that ICICI Prudential Growth Funds are there, right? SBI Tax Advantage Funds are there, that comes under the close-ended funds. So there is a stipulated maturity period is there. According to that, investors can able to do the transaction in that particular fund. Next one, interval funds are there, right? It's a both a mixture of open-ended and close-ended fund. We can say that Reliance yearly interval funds series 1 is there, the example, so that we can able to understand uh, how the interval funds are structured. Interval funds combine the feature of open-ended and close-ended. It's a combination of both open-ended as well as a uh, close-ended funds. They are open for a sale or redemption during the predetermined intervals at an AV related price. So open-ended funds, try to understand these three. Open-ended for a they can throughout the year they can invest in it, they can sell it, buy it. There is no restrictions over there. But close-ended funds, what will happen? There is a specific time period is there. According to that, the investor can going to subscribe for that particular schemes. But interval funds is a mixture of these two. Is a combined features. It is having both open-ended and closed-ended. Right? They are open for sale, right? They are open for sale. Along with that, they can redeem it their returns during the predetermined time period, time horizon, intervals at a NAV related prices. According to the NAV price, net asset value price, they can do the transaction. They can do the redemption. They can able to do in this interval fund. So as I said, Reliance yearly interval funds are there for an interval uh, funds example. And next one is based on in mutual funds are made a category on investment objectives according to on the basis of investment objectives. First one is growth fund. Along with that, income fund, balanced fund, and money market funds. So what exactly growth fund? In the sense that these growth funds the aim of a growth fund is to provide a capital appreciation, capital formation, right? Increasing the capital of that particular mutual fund over a medium and long term. Such schemes normally invest in a majority of their corps in equities. They are investing into the equity, so that majority of their stake in equity, in the sense that automatically the capital will be appreciated. They can do the capital formation. Studies have shown that returns from stocks have outperformed most other forms of investment held over the long term, right? Certain studies they given, according to the study, the investment in a stock that is good and that is give a better return over it, and that can lead to provide a capital appreciation over a medium as well as a long term uh, time period. We can say that interval the growth funds, we can say that Axis blue chip fund is there, Axis mid cap fund is there, in the kinds of growth funds. Fund which is going to invest it for the purpose of capital appreciation of that particular mutual fund objective. So that's why the the mutual fund can be categorized into investment objectives invested into the growth, that is investment into the equities. So and income funds are there. The main aim of a income funds, it means they can provide a regular and steady income to the investors. These funds, if the investors are going to invest it in mutual fund, income funds, mutual fund, then they can definitely get a regular and steady income. They will get from this. Say for example, SBI regular savings fund, the specific schemes are there. Say for example, SBI regular mutual fund, or sorry, SBI regular savings fund, or Aditya Birla Sun Life Treasury Optimizer Fund. These are the funds which can provide a regular and steady income to the investors, so that they can get it. Sorry, they can get it a better return over there. Such schemes generally invested in a fixed income maturity, where there is a fixed income maturity. As I said, in such kind of schemes, the income funds are going to uh, the investors are going to invest in income funds such as bonds, corporate debentures, government securities, whatever. Income funds are ideal for a capital stability and regular income. So these are the ideal. There is ideal funds for the we can maintain the stability in capital, along with that income they can get regularly or steadily uh, from this kind of funds. Okay, so growth funds, income funds. Next one, balanced fund. There is a balanced funds. The aim of a balanced fund is to they can manage, they can balance with both growth and income. It's a balance between the growth as well as income funds. Such schemes periodically distribute a part of their earnings and invest to both equities. Sorry. So balanced funds, it's a mixture of both. It's a balance between both growth as well as income funds. Such schemes periodically, what will happen? They can distribute a part of their earnings and invest both equities as well as fixed income securities. So growth fund, they can invest it into equities, or capital appreciation, what we can call, that can invest it into equities, so that they can increase the capital appreciation of that particular mutual fund. And fixed income securities, in the sense that they can invest it into the different securities, income securities, what we can call, uh, which can provide a regular and steady income for the investors. So it can invest into the both the growth as well as income funds. Say for example, JP Morgan Investor Growth Fund is there, and BMO Conservative Allocation Fund is there for a balanced fund. So in a rising stock market, the NAV of these schemes may not normally keep pace or fall equally when the market falls. These are ideal for investors looking for a combination of income and moderate growth. So if they are investing into the combination of both income and moderate funds, then they can go for balanced fund. Next one, the mutual fund, money market mutual funds, money market funds. The aim of these fund is to provide a liquidity, easy liquidity, and preservation of capital and moderate income. Right. So these schemes generally invest in sh- safer short-term instruments such as treasury bills, certificates of deposit. Wait a second. Okay. So sorry. Money market mutual funds, what we can call. This is all about the feature. The main aim the of this kind of a funds is to provide easy liquidity, right? they can reach out the short term obligations, right? Along with they can preserve for a capital as well as moderate income they can get it by investing into the money market mutual funds. So they can generally invest it into the safer short term instruments such as the treasury bills. They can invest it, right? You know that money market instruments, that may be the treasury bill or CD or CP, right? Call money. So these are all examples of a money market which we have studied in money market and capital market, right? The financial market while studying, you know that, right? They can invest it into treasury bills, it may be, or certificate of deposits or commercial paper and interbank call money. So returns on these schemes may fluctuate. The returns, of course, the while investing into these kind of funds, they can get it a return. That particular return may fluctuate. They may change depending upon the interest rates prevailing in the market. You know that as per the interest rate on that particular scheme, the return may fluctuate into the different instruments of of short term, what we can call sorry. Sorry. uh, Money market mutual funds, you know that they can invest into liquidity, right? They can preserve a capital as well as moderate income. These are the specific features of a money market mutual fund. They can get return over there by investing into the different money market instruments like treasury bill, certificate of deposit, commercial paper, interbank call money, whatever. So certain, so certain funds are there. SBI savings fund is there. L&T money market fund is there, for example, for a money market mutual fund. And lastly, others funds are also there that we will discuss. The first one is tax saving. Tax saving schemes or tax saving funds is nothing but to save the taxes. What are all the schemes available, right? Whether it may be, you can say that IDFC tax advantage fund is there. Kotak tax, Kotak's, sorry, Kotak tax saver fund, direct plan growth uh, fund is there for a tax saving. So they can investor they can save their taxes by investing into the specific kind of mutual fund. Say for example, ELSS, equity linked savings scheme, and pension schemes are allowed as deduction under Section 88 of the Income Tax Act 1961. The Act also provides opportunity to investors to save the capital gains under Section 54EA and 54EB by investing in mutual funds. So, there are some under specific provisions of Indian income tax laws, and government offers tax incentives for the investment in a specified avenues, specified schemes. That is nothing but tax saving scheme. And sector specific scheme, in the sense that there is a specified sectors are there, like so for example, ICICI Prudential Technology Fund, Technology Fund, and Aditya Birla Sun Life India Gen Next Fund, Gen Next Fund, which means the Generation Next Fund. So these are all kinds of funds which are related to the sector specific or specific sector funds. So industry specific schemes invest only in the industries, right? Sector, in the sense that that particular sector, that particular industry specified in the offer document, which is in detail they have mentioned in the offer document. The investment of these funds are limited to a specific industries like infotech, as I said, the technology fund, ICICI Prudential Technology Fund, right? Or fast moving consumer goods and any other pharmaceuticals, they are going to invest in that particular field or sector that we can call sector funds. So again, index fund is nothing but the attempt to replicate the performance of a particular index such as BSE, Sensex or NSE, NSE Nifty. So these kind of funds which are going to attempt their performance of a particular index in these kind of stock exchanges. And again, sectoral fund is there. They are exclusively these and specific sector are the same, but exclusively this can exclusively in a specified industry or a group of industry, various segments such as A group shares are initial public offerings. So for only different sector specific and sectoral funds, they are invested into different fields. Both are same, but yeah, there is a segment, again there is a segment, there is a group shares, right, or initial public offerings. According to that, they can invest it in these kind of sectoral funds. And lastly, we know that sectoral, ETF, exchange traded fund, right? So these are the funds like their index funds counterparts also track indexes. The difference is that stock of individual companies that comprise a given index are bundled into an equity like investment vehicle that is traded on an exchange, exactly like stock. So exchange traded funds are the fund which they are going to invest it into the stock and indexes. That's it. That means those purchasing ETF shares can place order from them throughout the day, and even use the limit orders to make trades, right? Because they are traded on an exchange and share many of the attributes of the individual equities. ETFs can also be shorted and offer underlying the options as an investment opportunity.